today. But let's get Dhiraj Sachdev in. He's managing partner and CIO at Roha Asset Managers to really take us through how he's seeing the markets from here on. Dhiraj, thanks for joining us today. I'll actually begin by asking you about the broader markets because, we are seeing a little bit of a pullback. I know there's been a very sharp rally, but even last week we got that, 3% drop on the mid-cap index. Do you think it's a one-off, or are we set for, more of these sharp corrections coming through, just considering how much we've run up?
So, good morning, Pavitra. So, on the overall market, we remain positive, given strong capex from government side across core sectors of the economy like infrastructure, besides thrust on manufacturing cycle improving and ongoing reforms in the power sector. So, broadly, corporate profits are expected to recover on fall in input costs, energy and freight costs, and easing of supply chain pressures of the past. Now, on the small and mid-cap side of the market, specifically speaking, it is unwise to generalize all the stocks into one basket, as this category has vast ocean of universe of stocks spanning over a few thousand companies. So one needs to have a bottom-up approach to stock picking, and despite the relative volatility or beta being higher than the large caps. Now, there are structural changes in defense procurement cycle with focus on local manufacturing and huge capex on railways, electronic manufacturing, which can be witnessed over the next decade or so. So there is a long runway to growth. Our stocks in this segment of defense, railways, EMS have largely moved ahead of time or have given upfronted returns far ahead of their earnings. So one has to be a little cautious in these spaces in the near term and elongate investment holding period cycle to beyond, say, 3 to 5 years, as the business outlook and earnings growth appears durable in these segments, given that the market size of these opportunities is fairly big. But the earnings are well discounted in advance. On the other side, sectors to play in within small cap segment currently include financials, NBFCs, chemicals, pharma, cement, select real estate, construction and engineering companies, where profit margins may have bottomed or where there is visibility of better earnings growth and market has not fully appreciated or discounted them due to lower expectation. Hence, these sectors would be preferred considering valuation comfort. So I do not believe we are in a bubble territory yet. And in a prolonged bull market, a routine 10 to 15% correction or time correction is quite normal. As mentioned, there are pockets of overvaluation and there are spaces which can be preferred. There are always potential opportunities with sector shift strategy in the market. So overall market valuation are by no means bubble-like and corrections are likely to be short-lived.
Dhiraj, morning. I want to just get back to that point about defense, railways, EMS companies, where you believe the valuations are discounting far too much growth in the future as well. How much of a correction would you want to see in these stocks for it to become attractive? Just want to understand the extent of overheating that we've seen in the valuations.
Well, I think correction is difficult to say what the extent of correction or the magnitude of correction, but one has to accept the fact that any bull market corrections can be 10 to 15% or even higher, especially some of these companies where there has been a meteoric rise. So we are not taking away the fact that the long-term opportunity, the capex cycle, the huge localization program in the defense is extremely high and durable as an opportunity. But since the market has already discounted a large part of the forward earnings in advance, it's acceptable to assume that there could be even 10, 15 or 20% correction in any of these companies.
And if we do get a 10, 15, 20% correction, would you recommend a buy?
For long-term investors, yes, because as I mentioned, it's a very durable opportunity. The size of the market in these segments is pretty big, and the earnings can actually be much higher 3-5 years down the line. So if one is taking a view beyond 3 to 5 years, yes, not in the near term.
Okay, got that. Dhiraj, you were also mentioning financials as one of the pockets that, you can still play parts of it at least. Take us through your call on the PSU banks, because just this month there's been a near 17% kind of rise. Do you think this is just the start of what is going to be a big up move in the space?
So overall banking and financial services sector, including PSUs, will sustain at least improved performance due to higher credit growth and stable net interest margins or lower credit costs and better return on assets. So PSUs for long had far discounted or deviated valuation versus private banks. And obviously that is somewhat getting corrected, though we do not expect all of them to have the same kind of 2 or 2.5 or 3 times adjusted book values kind of valuations, except for one being the leader. So there is a consolidation that has happened in the PSU banks as such. But we look at the banking and financial services inclusive of PSU banks, and we see that they are in a kind of a Goldilocks moment where growth as well as asset quality are in the right place at this point of time.
Okay. Coming back to the point about infrastructure and industrials, you did say you liked it. Do you want to elaborate which pockets over there would you be interested in? Would it be in the road construction? Would it be the ones which are linked to power? How would you play that theme?
So I think it's a very broader segment of the economy. And when we say capital goods, industrial, they will be driven by capex cycle recovery. We expect the execution of all the capital good companies and most of the EPC companies to remain healthy. I mean, this will be led by a strong order book position that they have accrued over the last 5-6 months or 5-6 quarters. So EBITDA margins will improve from the recent moderation in commodity prices as well. Now, there is a healthy inquiry pipeline. We talked about defense and railways, but beyond this, even segments like cement or waste heat recovery, waste to energy, decarbonization, hydrogen, EVs, robotics, data centers are all emerging capital expenditure areas which are driving order book. So we're not just confined to railways or defense, but there are a lot of other segments where the manufacturing cycle, if it improves, many of these segments like robotics, data centers, etc., will also do well over a period of time. Beyond these, I think capex is also happening across sugar and ethanol plants, water treatment, chemicals, etc. So there is a whole lot of opportunities in the capital goods or industrial space to choose from.
Okay, Dhiraj, got that, and a very interesting chat with you today. Thanks for joining us. We hope to have you back on the show as well so we can discuss some more ideas. But for now, it is time for a break. There's lots more market action that we're tracking in just a bit. Things are at the flat line, so we'll get talking about that when we come back.